Wow, what a wild market we're at. The S&P 500 is hovering right around 5,000. The 10-year note is at 415. It seems like everything is backwards. Wasn't it like 2 weeks ago everybody was talking about rates going down? Rates, I think the 10-year got to like 3.83 or something, and now it's up at 415. It's just a wacky, wacky world. Let's figure out what's going on in mortgage with Dustin from Convoy Home Loans. How you doing, buddy?
Good. How are you doing?
I'm doing well, man. Let me say it this way. There will be a day or a week where rates don't go haywire. That ain't this week. It wasn't last week. But it will eventually happen again. That much I'm sure, but I just don't know when. It's crazy, right?
Yeah, and to say heading into this week, you thought it was going to be a somewhat calm, calm watered week because there really wasn't much
Yeah.
on the schedule, right? I know we obviously have inflation. I think it's next
Tuesday, CPI Tuesday.
Tuesday 13th, right? Is that
Yep.
Tuesday?
Correct.
So a lot of speculation into what that'll do to rates, but yeah, going into this week, we were not expecting a on the non-QM side, we've seen rates go up 25, 30 basis points because we're actually tracking pretty closely right now, day in, day out, just like conventional is on the non-QM
Oh,
side. So
wow.
we're moving uh, at paces that I'm normally not accustomed to per se.
Yeah, and let's
But
let's
it's
remind
what we
people, right?
have to do.
Conventional rates move every day. Really, they can move several times a day.
Yeah,
Non-QM historically has not really been a daily mover. Is that fair?
100% true.
So the fact that it's moved to daily mover should tell you all you need to know what's going on in the mortgage market.
Yeah, and one thing that we always talk about, right? Non-QMs getting bought and sold on Wall Street, they tend to be a little bit more forward-looking than kind of knee-jerk reacting like conventional or FHA government pricing does. But a lot of times Wall Street stands still because they believe that they are actually whatever, their speculation on rates will be is true, and they feel comfortable about holding it there for a longer time. Right now, they don't. And
Yeah.
you can see,
Yeah.
market traders are like, well, maybe we do have to believe the Feds because they've said it about 9 times that we're not ready to cut rates as soon as
Yeah, they
possible.
haven't changed. They've been
Yeah,
pretty consistent.
yeah.
That's hilarious. So, again, rates are up. Like it, lock it. I think it's something we've been preaching for 6 or 9 months easy. Um, I've actually heard some stories about folks that were betting the other way, so they didn't lock, and now they're like, ugh, like be careful out there.
No, and it's frustrating because I've had that conversation with a handful of clients in the last about 2 weeks that wanted to ride the wave of rates are going to be a lot lower, in
Yeah,
the
of
next couple weeks or month. And these were clients that I had that I couldn't convince, and that's maybe my fault, but maybe not because I always let the client decide ultimately,
course.
right?
Yeah.
That we had loans basically ready to go to closing, had docs ready to go. I even called them. There's 3 people that I called last Wednesday when we saw the 5 year
Oh,
and the 10 year drop
wow.
down to like 3.8, 3.85. Okay. I was like,
Yep, I
look,
remember.
we're good. There's no really, point in my opinion to go ahead and float it any longer. We've seen kind of the
Yeah.
resistance level about 4 and 4.1 is not where we want to get to. And now one of them called me late last night, ready to go. I'm like, well, we're doing a DSCR loan. We had to be above 1 for this particular lender. Now all of a sudden you're getting 60,000 less cash than when I called you on Wednesday. So,
I want to
those are
say
the
that again.
things.
I want because you just said that like that's like most people get it. So this is a DSCR loan. It basically at when the 10-year was at 3.8, you could get them an extra 60 grand. Now, because there's a DSCR loan, because the interest rate's higher, they're going to end up with 60 grand less, which means equity in the building is bigger, more, I mean, depending on a refi or a cash or a purchase, but that's 4 freaking business days.
Exactly.
So be careful, folks.
Yeah, and one thing to put on top of that is like you need to be working with a professional that does follow the market like that. We've said that a bunch. But when you're also at the beginning stages, like shopping you have to do. We're not saying don't do that. But when you shop, make sure you're comparing apples to apples, not terms I'm talking about, but literally the same day. If you get a quote from me or a quote from another lender on Monday, and then you speak to me on Friday, don't compare those quotes. Those are so
Oh,
far, off because of what's obviously going on. You can see in this week a 30 basis point movement.
yeah, it's wild this week. So one of the things that most people will think about is rates. The thing that I actually look about, and I talked about way back when in my first book, is I think there's two markets that once you get to be a decent investor, you track. One is obviously the real estate, aka housing market, but the other is the lending market. So I am curious what's going on in the lending, aka risk. Are lenders raising LTVs, right? Did maybe they got nervous and they went to 65. Now they're at 70 or 75. Are DSCR loans that were okay at 1.1, are they going to 1? Are they going up to 1.25? Where are lenders on the risk curve accepting more risk or less risk?
So you would assume, right, based on the kind of wacky week that we've had with rates going up and kind of the concern or speculation that nobody really knows when the feds are going to cut, that the risk levels from the lender side of you would be reduced, right?
Okay.
But we've seen the opposite. Now, I'm not the biggest, proponent that this is the way that the industry should be going right now, but
Mhm.
a lot of it was once rates took a pretty massive drop in December at the end of December because of the speculation on what the feds were going to do in 2024, everybody was like, all right, it's game time. Let's start rolling out, less of a hit on if your DSCR is below 1. Let's start rolling out, bridges that go up to 92, 95% if you want with rehab.
Wait. Bridge debt to 92?
On the loan to cost, sometimes 95, which is wild because we haven't had that in
Oh,
about two and a half or
forever.
3 years.
Yeah.
And
Wow.
the riskiest investment, as you saw from the retail bank collapses, is, I'm not going to say it's bridge specifically, but any type of heavy rehab, ground up
Oh,
construction,
yeah.
that's
It's
risky.
time, like development time and loan time. That is not a good combination.
And to give them now more leverage so that they're even now on a tighter, window, and not just with time, but a tighter equity play that they have
Yeah.
to now fix and flip this on is a bit surprising. But I just
Let's play with that a little bit because I agree with you. My knee-jerk reaction would have been the market's crazy, let's be more conservative. That's where I think my head would have gone. But what you're saying now is they're being less conservative. So let's play with that. What happened in January? I think one thing happened in January that I've been waiting for, and I've actually called out that banks will look at this as, like it's go time. And that was finally the Fed saying we're done hiking.
yep.
And I think that happened in January. At the Fed meeting in January, Jerome Powell essentially said we're at the terminal rate. Up until that point, including the December meeting, it was like, well, we might got to go one more time. That's gone. So, and I think you're actually seeing that in the spread. I think the spread has gone from over 300 basis points to like 275,
Correct.
and might even be coming in from there. So maybe actually what we're seeing is just some banks getting a jump on that, going, okay, the Fed, we know where the terminal rate is, so we don't have any upside risk. Now it's all downside. Because the other thing I think we can all say with confidence is the next move is lower. The problem is we don't know when, right?
Exactly.
But the next move is lower. So I don't know. Maybe it makes sense. It's certainly not my area of expertise, but it's interesting to think about.
So in my opinion, from a business standpoint, if you're the one that's sitting at the, bank or lender's actual board of managing your balance sheet, your company's balance sheet,
Right.
it
Yep.
does not make sense to be more risky in this environment right now. What I
Okay.
think honestly happened, okay, is FOMO. A lot of people use that, but the fear of missing out amongst lenders because they're seeing their competitors now all of a sudden start rolling out, more leverage, higher leverage programs, reducing the floor rate on their rate sheet, right? To be able to advertise,
Yeah.
hey, 4.8 FHA. Don't read the disclaimer. Big 4.8 FHA, right?
Yeah. Big number, little disclaimer.
That is what I think has driven everything, and because we've seen a
Interesting.
lot of spin-offs of companies, M&As of companies that now, let's say 6 months to 12 months ago, were silent, radio silent. They jacked their rate sheets up 2% so no volume would come through, right?
Right, right.
They
Yeah,
kind of fixed their problems. And then they roll out all these new higher leverage, lower floor rate products. And the people that have been here, the lenders that have been here for the last year and a half, still surviving, are
right.
looking at them like, now you're taking away our business that we had a control on. So now we need to do the
Ah,
same. And I don't think it's a coincidence that this all happened, right? From basically the middle end of December to where we are now. But now most of the lenders that did that are thinking, shoot, I probably should not have. And I would be, let's see what our video is in 3 months from now
mhm.
to see if all these higher leverage rate products are still there. I don't think they will be. We'll see. That's my
Well, I
prediction.
think that logically makes sense. So let me kind of translate what you said to a novice understanding, because you're in the industry, you see it all,
Yeah,
and maybe
sorry.
no, it's great. I love it. That's why we're here. We want to get the inside baseball. So what I think you're saying is kind of last summer there was a lot of pain in your industry. So a lot of people had loan products or portfolios they couldn't sell. They were taking discounts. They basically had to stop lending. So how they did that is they raised rates so the flow, or whatever you guys call it, would stop.
Yep.
Their outcome was likely a sale or acquisition or whatever to some other stronger balance sheet entity. That those transactions happened, some closed their doors, blah 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 blah. Now you get to December, there's new entrants with new strength with no pipeline.
Exactly.
So what do you do when you have no pipeline? You cut price. You advertise like crazy. You generate interest. Now the people that were strong through the summer are looking at December going, where the hell did this come from? What are these people are undercutting me? What happened? And then I don't know, competitive instincts, you match or get close or whatever. And now we're like into Q1 and we're like, this doesn't feel great. Where's the margin and risk profile? Do I have all that right?
No, and that's all the way that you explained it, to the novice listener is exactly how I would have tried to communicate it. I may have just been a little too enthusiastic using, specifically mortgage industry expert lingo.
Oh, it's all good.
Um, but that's 100% true. Um, the one thing that I've seen that a lot of, I would say, consumers and even other brokers out there that don't do, I'm not trying to beat my chest here, but maybe the volume or the relationships that we have with certain hedge funds on Wall Street or life insurance groups, etc. A common theme that I have seen is, so let's say a year ago or even 2 years ago, I knew another, bank or lender that was selling a certain product to an investor. And I would go to my investor and be like, look, they're sending these types of loans at this leverage with this sort of spread and this type of rate. What can we get, to match so that I can offer the same thing, right? 7 out of 10 times when I did that a year ago or 2 years ago, I was like, F off, right? Like,
Ah,
figure it out. We'll take what we already agreed to buy
yeah.
from you in this box,
Yep.
stick to that, or we won't buy the loan. I'm like, okay, I get it.
Yeah.
That's
Yeah.
fine. We'll
Yeah.
figure it out.
Understand, Mr. Customer. Got
Yeah.
it.
Now, anytime I try and, tell one of my investors that we sell these loans to, now these are, billion-dollar companies, multi-billion
Yeah.
dollar companies that really shouldn't be dealing with people like me. But ultimately, now when I show them a sheet saying, look at this buy box and look at the rates they're getting, can we sell this type of loan to you? It's a 1 day underwrite it, boom, sign off, here you go.
Interesting. So again, I
That's
don't
the
know the
FOMO
industry at
part
all.
I'm tying
Yeah.
together. The competitiveness, like okay, they're doing that. Yeah, we can do that. Because, like you said, their margin, their spread that they have
Yeah.
is still really comfy and
Beefy.
juicy for that, right?
Yeah. And at the end of the day, a big juicy spread with no flow means nothing. So what I hear you saying is there's so much competitive juices around this float that they'll take a 5 basis point cut just to increase the flow rate. Because again, it's flow times spread equals profit.
Yep.
I get it now.
And I
Interesting.
don't love it because look, it takes away my because like you said, I was doing well in my opinion compared to the rest of the industry in
No
the
question.
middle of summer, right?
Yeah, you were again, we've talked about it. The industry saw a 50 to 60% haircut. The strong would survive, which Convoy clearly did. So yeah, you were I don't know, the top quartile easily in the industry, if not the top 10%. And then you get this wake up call in Q4. It's like, where these guys come from?
Exactly. So now all of my and I see it just I don't know the numbers. I don't keep track of this and it'd be hard to, but the amount of shopping that I get done when I'm speaking to a client for the first time saying, look at all these other offers I got. I got this one that's, $1,000 less that I was priced out 2 weeks ago. This one's got point one
Yeah.
low. That didn't exist six
No,
months
you were
ago
it.
because there was
You were the
nobody
only,
else doing it.
no, you were the only option. You were the
Yeah.
only game in town. That is
Yeah.
really interesting. So again, kind of playing the future here, which is sometimes where I like to play. What you're basically saying is what I think you're saying is this is probably going to be a like a caffeine high. They're going to go get the share, they're going to increase the flow, and then this has to stop. Like 95% of loan to cost in a 1 year bridge debt, freaking new construction or heavy remodel. That just doesn't feel right to me.
I mean, just 95. Like, where do you hear the number 95 in the mortgage industry? Okay, first time home buyer, FHA or VA.
Uh,
We
yeah,
want to get
government.
those people in,
Yeah,
right?
yeah,
Yeah, government loans.
yeah.
Your primary
Totally cool.
residence,
Totally
we
fine.
want, yeah, be able to have a lower barrier for entry to be a homeowner, which
Yeah.
our government wants. You're
Yes.
doing an investment and you got no skin in the game and you expect to turn this around in 12 months. Like, that's
Yeah, you got a
risky.
500K remodel. You've
Yeah.
never done one before. Oh, this
Exactly.
feels messy, man. This feels messy. Oh,
Yeah.
dude. So again, we got a little bit of time left. Let's talk about next week. Because next week we have CPI, Tuesday, the 13th. Uh, I actually think CPI is going to come in at I think the last time was like 3.2 or 3.3, something like that. It might come down to 3, all because of the base effect. Although oil has been up the last 4 days, so we got to, it's been going up. But rent's got to roll over, shelter's got to roll over. I think
Yeah.
Tuesday, I think Tuesday could be another interesting day in mortgage.
It's yeah, I'm not nervous about it. I'm just so used to it now with what's
Exactly.
gonna happen, right? Uh it does feel like a straight coin toss for me. I think and correct me if I'm wrong, you know this better than me, but
Yeah.
I think last year we had this same situation and it kind of played into the jobs reports last week where a lot of these numbers you might have to take with a grain of salt
No question.
because of the seasonal, you know, portion of the numbers
Yep.
that we're getting, which
Yep.
is going to be the rollover, right? Anytime you're going from December of the high season, which is why we probably had so many jobs, right? To now January, those inflation numbers, I don't know what it was last year, but if I recall, or I think I'm right, okay, we had it a lot lower than expected. CPI came lower, which was the good thing that the market wanted,
Mhm.
right? But that was a portion of the reason was because of the seasonality of the
Yeah.
report that we're getting.
Yeah, the whole base effect thing. And again, last year we were rolling off some of the highest number ever as far as the base effect or the spread.
Yeah.
It's I don't think there's any question that inflation's heading lower. Although we do have to watch oil. Oil and energy is in everything. The Fed focuses on core, which is obviously X oil, X food. Yeah, I think Tuesday is going to be an interesting day. I think the Fed's going to get more ammunition that inflation's coming in and the job market is still strong, at least based on their kind of backwards looking numbers. And we're gonna hear a lot more talk of soft landing, I think, starting Tuesday. So it'll be interesting.
Yeah, and I'll just say it again that we say all the time, but mortgage rates right now, if you want to know what's going on with mortgage rates, sure, you can look at the 5 and the 10 year, right? But they're going to follow essentially what the market is speculating the feds are going to do with rate cuts. And why is inflation important for mortgage rates? Because that'll tell us whether the feds believe we are due for a rate cut sooner than expected or it's going to be longer than expected. So that's what we'll see on Tuesday.
Yeah, I mean, if inflation goes up, the chances of a May rate cut got to go to zero, right? March is already off the table, folks. It's not happening.
Yeah.
But if inflation goes up, not my call, but if inflation does go up, you could take May and probably take June off the table.
Yep.
But if inflation crashes and let's just pretend for a moment it shows 2.9, we could talk about a May rate cut, right?
What are the odds right now in May? I know it went down a little bit, but like 50 or 60, I think
Yeah,
now.
I think it's like
As
50.
of this
I think I
morning.
checked this morning, 53 or 54. So basically a coin toss for May.
Yeah, and then what's crazy just hearing this come out of your mouth, because we spoke about this 2 months ago, maybe May, maybe June. 2 months ago, everyone was like 4 to 6
March.
rate cuts.
Yeah,
And
oh
we
yeah.
were like,
Nope,
hold
not
tight,
happening.
sit tight. Yeah. So it's I mean the biggest thing I've in terms of overall learned just from being in the industry for so long is look, the feds, nobody knows what they are doing. And even if the market is trying to tell you that they think it's going to be headed some way, you cannot take that and bet your investments, especially on real estate, like floating a rate lock or holding out on buying just because of that only.
Absolutely. At the end of the day, folks, we're going to be talking every week. Also, you're going to be in Vegas. You're coming out to Vegas for the event. So we will
Yeah.
see you there.
Excited.
Uh, Dustin, if somebody wanted to reach out, get a quote, compare, contrast, see what's what, how do they do that?
Yeah, go to convoyhomeloans.com and please mention that you came from ORAP. There's a special little drop down just for you guys that says came from ORAP.
And if you don't know what that means you get to talk with Dustin and or his partner, Jonathan. If you don't say ORAT, you're going to get one of the minions.
Yeah, and
I'd
look, we've
rather
got
deal with the
about there's they can filter through and they have, and I've said that in the past. We've got 40 other people here, so make sure it's me or John.
There you go. They will take care of you one rental at a time. You're amazing, man. We'll see you in Vegas.
Thanks,
Later.
Mike.